Hi all, I am Sham. I have Kishan with me.
Hi, Sham.
Welcome to another episode of Refloat. Today we'll be discussing diversification. It's essentially the idea behind that is fairly simple and straightforward. It's that don't hitch your wagon to a single pony. You don't know what's going to happen to equities or bonds specifically 5, 10 years down the line. So what you do is you put a little bit in bonds, a little bit in equities, a little bit in gold, a little bit in real estate, and a little bit in a savings account. Um, so that overall your returns are not volatile and you're not dependent on one specific asset class. So far, so good. But the problem that I have personally with this is um, it is broadly true if you were in the US. Most of the research that highlights the superiority of broad-based diversification is based on the experience of um, an average US investor over the last few decades, actually. So right from World War II through now, what they're saying is correct. Like a 60-40 portfolio that seems to be the most common thing. It's almost like aspirin, right? That your doctor prescribes. Oh, I'm feeling a headache coming. Oh, let me just take an aspirin. It's like that. That 60-40 portfolio where you put 60% of your wealth in equities and 40% in bonds is almost like that. Everybody does that. It's like the bedrock of most portfolio design there. And that's largely worked out for them, right? It has reduced volatility of returns. It has given decent returns. The stock market is awesome. So, the stock portfolio side of things, just buy the S&P 500 index and be done with it. Why put so much effort into beating an index when the index itself you know, uh, is giving that? So that's been the basic sort of approach, right? So Kishan, do you want to chime in?
Yeah,
Yeah.
yeah. So I think I think most things we read about finance, even today, is mostly to do with it being US-centric. And like you said, like many of the things that we hear, for example, there's no point to active management. Just invest in passive strategies because it's very hard to beat the market. I think that in India is still not true. I think I mean, active management. I mean, every year, even mutual funds, which are inherently uncompetitive. In the sense that it what they offer. Still, most mutual funds end up beating Nifty. I mean, it's become much harder in the last, I think, few years. But if you, but outperformance by by a simple large cap fund is still is still there. Compared to even with 2.3%, the expense ratio, they still beat Nifty. So I think like most things we hear today, like ESG investing. Yeah. So I mean, I think I mean, I think you said this or somebody had said it that I read yesterday that that many companies, many funds today are coming out with like ESG funds, and the thing of ESG, E stands for ethical. so, so there's really not much you can say about that in India. I mean, what your universe will be is God knows. So uh, so so yeah. I mean, I think most things that we read is mostly US centric, and the rest of the world, you know, has to blindly follow it. As you said, whether you're cold or cough, the cure is one medicine.
Yeah, so and it's kind of unfortunate because what happens is, see, they have a robust data set, right? So the Chicago school set up the CRISP CRSP data set in the 70s, and since then they've been collecting data, going back, all the way to 1900s or something like that. So they have all that set up. So obviously, if you're a researcher, you want to analyze that data first, and you can tease out statistical features from that data set.
Yeah,
But if you look at India, right, I mean, people, uh, they look at data from like 2005, because that's
yeah,
where, I mean, that's
yeah,
pretty much from when you have total return data available for most indices.
yeah.
And that's like 15 years. What are you
Which
supposed to
is
do with it?
yeah, which is not even like I think it's probably uh, maybe 2 or 3 seconds, and so you don't really even have data for for though the markets have been around for a long time, and I'm sure there's data somewhere, but no one's had no one's taken the trouble to go to backfill the data because you can see research in the US. You can see, like the Dow Jones for like the last 150 years, somebody has actually gone back and taken the pain, and definitely the markets are not the same like today it is the way it was 120 years ago, but you still, if you want a data, it's still there. No one's done that in India, in a
Right.
sense.
So the thing is partly because BSE was notorious in
Yeah,
maintaining records, and most of corporate actions and all that information that the exchange was supposed to maintain, they themselves don't have it. So like ridiculous. So even Sensex index was, it's not dependable going back, before 95 or something like that. It's a shambles.
right.
So prices, once again, you depend on closing prices, but closing prices are like a weighted average, volume weighted average of the last 15 minutes, right?
Yeah,
So that requires someone to actually compute it, right? That someone is the exchange, and those guys themselves did not do it. Uh,
yeah, and I think what also happens in India a lot is that the data that you have, before say, even the data that you have is also, there's a lot of changes to it, so like, and that is not always properly captured. That in, like I said, that you have no corporate information, say, uh, since when, till what point is the data lost? But that information right now, it's like comparing apples and oranges if you don't have the data. So I think in India, a lot of the data also does not take into account the change in regime.
yeah. So we have that problem, and the second problem is that in the US, right, things have always worked out.
Yeah, yeah,
That
exactly.
Yeah, so they go through hell and high water, but it always works out for them. It's like the
Yeah,
luckiest market in the world. Partly because they have the reserve currency, right? So
yeah,
they can print how much ever dollars they want. Doesn't cause them any inflation. In fact, when I was there, an uncle of mine was telling me that he's been in the US for the last 15, 20 years or something at that point. And he was telling me that the price of chicken breast has not changed. Oh, like 20 years.
yeah,
So he told me that, he goes to the supermarket, he knows that, it's like $2.50 or something. He doesn't even have to worry about it. It's been the same. And just remarkable the amount of
yeah.
changes that the world economy has gone through. They had bouts of hyperinflation and all that stuff. But, for an end consumer, right?
It's the same.
Yeah, it's the
I mean,
same.
yeah,
So it's
yeah.
always worked out. That market it's so resilient. So 2008, the whole world collapses, but these guys, turn out to be the best performing market over the next 10 years. It's
Yeah.
incredible.
Yeah. So I mean, I think yeah. The second thing is, US is an outlier in like all of this. So I think, if you compare it to maybe any other market, like, Japan, has been on a 20, 30-year drawdown. I mean, not drawdown, but it just reached as high as last year and then it fell again,
Yeah.
that they hit it in 989. So I think, yeah, I mean, US is is more or less an outlier just because, what it works in one market or the other. I mean, it's not true. The thing I liked about, your post this week is uh, the bonds in India have had a 30% drawdown.
Yep.
That's mainly because there's no liquidity in the market. I mean, there's no liquidity to, uh, for price discovery to happen.
Right.
Uh,
And not only that, so that period, right, it involves our own tryst with stagflation,
yeah,
where we had double-digit inflation and no growth.
yeah,
And, we had our own version of credit crisis because of, the UPA government
yeah,
forcing banks to lend and so on and so forth. So obviously, capital fled the markets and, it hammered our bonds. But at the same time, right, what's remarkable is people don't seem to care, right? I mean, advisors in India, most of them,
don't understand. Yeah, don't understand this part because I think it's just blind, right? Even the investment advisory course from SEBI or stuff, do not talk about in depth about these things. I mean, I remember one guy way back in 2014 or 13 used to tell me just buy liquid funds. There's no risk to it, and this particular liquid fund had all kinds of investments in it. It is not just treasury paper. It was like all kinds of corporate bonds, and then like there's a credit risk. To all of this, and I think people just think of it naturally as they think of fixed deposits. I think even bond funds are sold as as an alternative to to fixed deposits. So that's the thinking. You know, and most people who like invest in debt funds.
right. And so the thing is, so when you do a 60/40, with this situation, right, if you just blindly apply the formula, you're going to be sorely disappointed, right? Because Indian stocks over the last 10 years, if you just in dollar terms, because
Yeah,
like I
it's been
pointed
negative.
out, yeah, like last week we pointed out that if you convert to dollars, right, it's like a shorthand for inflation adjustment, right?
Yeah,
um so if you convert to dollars over the last 10 years, your Nifty 50 has been flat,
yeah,
right? So and in dollar terms, bonds have returned negative returns. So overall, if you do a 60/40 on this, you're flat to negative returns over the last 10 years. So you just you put $10 in, and now you can take $10 out. Congratulations. um, so the problem is that, right? So
yeah,
what do you do in this situation? Like, what diversification is often missold
yeah,
as something, as a free lunch. It may have been a free lunch for American investors in America, investing in American assets, but Indians always get the short end of the stick, and not just Indians, just EMs in general.
yeah, right.
Yeah.
No, I think the point of diversification is your source of returns are diversified. I think that's a basic point. So whether you're investing, I mean, the reason why you invest in 20 different stocks is because you don't want to put all your eggs in one basket. And I think the point of diversification is and this is something that we advocate as a policy too, that someone should have different asset classes to diversify. But as you said, sometimes diversifying into different asset classes is I mean, you need to know what you're getting into and what the risks are.
Yeah, absolutely. And also, what asset class you're using to diversify matters a lot.
Yeah, and
It is
and
100% way more important than just blindly, okay, I'll go buy, some real estate, I'll go buy this, I'll go put
yeah,
everything in one basket,
yeah,
right?
and I think yeah, because like you said, right, all assets today, you know, um, especially when during bad times, are correlated. So like we saw this in March, where the markets fell, but so did bond funds, the ones that invest in corporate bonds. They fell because the credit spreads were extreme, got widened, and one fund went bust in India. So all those things really happen, and so if somebody were invested in both equity and a bond, and they saw both of them drop, they would have been shocked, and the entire point of diversification would have lost. But then if you invested in gilt funds, and you're looking at just the mark to market return, the mark to market return would have looked tremendous, because yields fell and prices went up. So and if you did that instead of investing in corporate bonds, then for you that diversification part would have made sense. So uh, I think it's very important. And if you invest in commodities, like you make a point, in March, those commodities, oil went to negative. So you would have been, really, and if you invest in gold, though most people don't say invest in gold, uh, it's up what 28% or so this year. So
Yeah.
I think you would have made that part would have made sense. Though actually most of the return in gold came with the rise in the equity market, it's pretty correlated. So I'm not advocating that gold is a good source of diversification, but at least it's not correlated to oil. And so I don't know. I think it really depends on what's the purpose of diversification. If it's to diversify the source of risk, and to have returns which are not dependent on the market, on the larger economic growing and stuff, then then you need something which is where there's more certainty.
In my I'm a big fan of sovereign gold bonds of the RBI. So I've been putting a chunk of my monthly savings into their program on a systematic basis. Partly because I don't trust the rupee
Right.
one bit. So all this is one big what they call Nautanki, right? So it's like a
Yeah.
joke for most of these political guys.
Yeah.
They don't understand why they should you know treat capital better.
Yeah.
It boils down to
Yeah. This is the same thing, going to do with PFCs, right? It's the same thing. Everything will end up getting ruined if you don't, treat capital better. It's just that, and not just short term, you have to have a, like respect, the rule of law and stuff. So yeah, I get your point. And see, that's a diversification for you, because you see it, that risk, and that risk, you're trying to guard against that risk because of a particular, to a particular asset that you foresee. Now, imagine if you, took that thing and put it in a bond fund or fixed deposit, and at some point you're in that risk, you're aiming for hyperinflation or stagflation, or and stuff. So actually, if you did that, to protect against that risk, you will end up being much poorer than you if you just invest in equity, because if there's high inflation, equities would rise nominally with inflation. So uh, so you need to know, first of all, what's the point of diversification. It's not blind. If you're somebody who's extremely wealthy, who has who doesn't have to really depend on on uh, it doesn't really have to think about retirement and stuff like that. You could really have 100% stock portfolio, um, which is not a high risk. You can have probably 100 stocks in a 100% stock portfolio diversified, and you're basically taking probably 5% of the funds every year to meet your expenses, and that's a better strategy for you than probably just putting 60/40 in bond, because what's the point? At the end of the day, you're trying to preserve wealth for your future generations, and this might be a better strategy for you overall than just than just you know than just blindly just following 60/40 strategy. I think I mean
Right.
there's a every objective, like we say, is or every investment advice should be based on a personal objective, and it should be very thoughtful. Just putting 60/40 blindly would not. I mean, is not everyone's cup of tea. I mean, it's just without taking into consideration everyone's financial objective. It's not. It
Right.
doesn't make sense.
And so the interesting point you said was wealth preservation versus wealth creation,
Yeah.
right? So there's a big difference between how you set up a portfolio for preserving wealth. If you're just looking at preserving wealth, you just want to beat inflation. That's your
Yeah.
primary objective. So how you build that portfolio is completely different from,
Exactly.
yeah, someone who says create wealth for me over the next 20-30 years so that I get my savings plus some sort of a nest egg to retire on, right? So that's a completely different, that comes into the financial planning phase. But my post is mostly towards this blind adherence to, towards a formula of 60/40, or there's also this permanent portfolio that we'll discuss in future posts. So these are all
Yeah.
like formulaic stuff, that has been handed down to us from US based advisors or researchers, and we are blindly following them, substituting Indian assets, right? But my point is,
Also,
you need to
yeah.
go a step further back and say what assets you first need to build a portfolio.
Yeah.
It can't be all just Indian assets. It can't be all just US assets. It can't be all just real estate, so, and how do you even like take that step back and figure out what it is that needs to go into this basket? Is it's my That's my first point. It is, don't be blind and just follow US guys.
Whatever,
Yeah.
blindly. Okay. Yeah. I get it.
And yeah, so, and we end with commodities, which I personally hate. I hate commodity investing, because in my own life I have seen, like the minute some commodity becomes, oh my God, this is so rare, everybody needs to, everybody's going to need it 10 years down the line, so let's buy it now, has never panned out, right? I have seen investors go gaga over rare earth metals. Remember China was cornering the earth, rare earths, some nonsense,
Yeah.
and that never, worked out. Now it's like lithium, people chasing behind lithium because, apparently all
Lithium.
batteries, yeah.
Yeah.
But let me tell you this, right? There was a time when our toothbrush was made out of boar's uh, bristles.
Okay.
The boars, the boar.
I,
Yeah,
I
yeah.
have no
So it's like
idea.
pigs. It's like a bigger.
Yeah.
So they used to take bristles from that and make toothbrush out of it, right? So at one point, a toothbrush was a novelty. Only nobles could afford it
Yeah.
because it was so bloody expensive. Um, but now it's like toothbrush, man. It's like $20. Who cares, right?
Yeah.
So it got substituted out. Before oil, was before people figured out how to refine oil in an industrial scale, your lamps were lit by whale's oil. So you had to basically harpoon a whale to extract oil out of it and make light out of it. I mean, to light your house. And lipstick had the same problem. So all that stuff has been substituted out. So
Yeah.
this is like the
Exactly.
biggest problem with
Yeah.
commodities.
And yeah, and I think most. I mean, the only reason why you saw a commodity boom in 2002 to, let's say, 2010 or so was because of China. China, I mean, I'm sure you've seen these charts of like where China used to consume steel and cement more than the next top 10 countries and stuff.
Right.
So China had this huge appetite, in those years, and that created this commodities boom. and then that just disappeared. And just because there's a huge demand for lithium, it doesn't mean the price dynamics or the supply and demand dynamics of the industry is much deeper than just, oh my god, lithium is the next oil. It's much more deeper than that. So I would say that just blindly investing in commodities is without understanding at a deeper level.
Yeah.
And the thing, Warren Buffett, has a brilliant thing, right? Commodities can go up. Something like commodities can only go up or down, right? That's the only thing that it can do. But predicting that is very hard, compared to buying stocks, which is you have something called earnings, and if a company's earnings grow, then by 10%, and the PE is the same, then the stock should rise by 10%. That's more predictable. As an investment strategy than investing commodities where you're predicting it up and down, and there's so many factors from weather to other supply markets and stuff like that you have no control over, and it's very hard to predict that. So yeah, investing commodities is probably the worst. It's not for most people in this world.
Yeah. So anyway, we figured we'll kick this off with this sort of backdrop, right? So when we discuss our next post on different ways of filtering, the assets that go into your basket, and then figure out, how you have to distribute your investment across these assets and so on and so forth. So, but all that discussion will be based on this, over this backdrop, right? So this is what we believe in. We believe that, you can't just blindly take, hand-me-downs from the US and apply it here. And at the same time, being, in an emerging market economy, you're better off having diversification beyond your personal market, and diversification just doesn't mean grabbing whatever assets you can think of and dumping it into a basket. So with that in place, we hope that the future discussions will be kind of clearer and based off of on this. So thank you for tuning in, guys. We will see you again next week, and we will discuss 60-40 with a twist.
Yeah.
Until then, see ya.
See ya.